Hey, I'm Andrew Malcolm from Mortgage HQ, and today we are going to look at Wealth Can't Wait, and the subtitle is Avoid the 7 Wealth Traps, Implement the 7 Business Pillars, and Complete a Life Audit Today. And this is by David and Paul, and these guys are absolutely killing it in business and life. David, he's got 4,300 real estate agents working in some form or function under him. He owns a lot of franchises in America. Paul, he's got 2,200 agents working under him. He's got 700 rental units. These guys really have dedicated their life to building wealth and and philanthropy and family, and they're really they're doing well, and they've come from humble beginnings. So what they have to say is worth listening to. So in reviewing this book, you can see just how many bookmarks I've got in this book and how many dog ears. It's a really good book. There's a lot to take away from it. Wealth is code for freedom. That's really a key message. The ultimate gift in life is having the freedom to choose what you want to do, when you want to do it, and how you want to do it. And wealth is your way to be able to do that. You get a lot more contentment in life when you don't have to worry about money. And building wealth means you can give your money away. So if you want to support the community or the church, your family, your friends, you want to enjoy the finer things in life, you're going to need money, you're going to need wealth. And these guys talk about horizontal income streams. What you want to do instead of just working, swapping time for money, or working 40, 60, 80-hour weeks in your own business. Maybe that's a good way to build some streams of income. But these guys talk about building a horizontal stream of income from bonds, shares, rental properties, owning assets and leasing them out, and they think about their money horizontally. These guys are trying to say to hold yourself accountable and to be the captain of your own ship. And basically, if somebody is not accepting or buying into your plan that you want to build wealth, maybe you don't need to listen to them. Maybe you don't need them around. Maybe you don't need to be friends with people that don't believe that you in particular can build wealth. I saw a guy in the Property Investors Facebook chat group the other day posting that his dad didn't think he was going to be able to build wealth and financial freedom. And basically, a lot of the successful property investors were saying, don't listen, you can do it. You don't need to be a genius, but you do need to work hard, follow good frameworks. And this book does provide those frameworks. So, having talked with a couple thousand people about properties and about investing, one thing, a lesson that comes from this book, and that I would have to say, I was reminded of, is that scared money doesn't make money. For you to be able to make money from property investing and from doing deals, sometimes you're going to have to pull the trigger on things that other people haven't seen the opportunity, and there might be an element of being a little bit fearful. But if you don't do anything and you just sit there and do no deals, it's very unlikely you're going to make money. And basically, people they loathe accountability, and this book talks heaps about accountability, about working in a tight group of friends or investor partners that you can talk to people about the deals you want to do and learn from them, and you'll be on the same wavelength with people. And when you say, hey, I'm going to make 10 offers on 10 properties in the next 3 weeks, you say that to your accountability partner, and you don't end up following through with that. Maybe you only do one. Then your accountability partner has to be able to say to you, hey, look, how serious are you about this goal? Now, these guys lived below their means for 20 years to build up the asset base and to build a momentum machine for wealth building. You don't just have $100 million property portfolio overnight. It starts with one property, and then it starts with building up your equity, saving a bit more money, and then maybe 2 properties 2 or 3 years later, and then again. And like, these guys have built their massive wealth. A lot of it, over the 20-30 years they've been building wealth, has been built in the last 3 or 4 years because they spotted opportunities. And I believe they wrote this book maybe 3 or 4 years after the 2008-2009 crash, and they really took that opportunity to buy assets undervalued because they were ready. They were cash rich, they were asset rich, and they had been studying the market for a long time. These guys are talking about embracing the wealth mindset. And if you haven't read Rich Dad Poor Dad, I suggest you pick that one up. And if you've got friends, family, partner, parents that they haven't grasped that same rich mindset, the Rich Dad Poor Dad book is a really good starting point for helping you see the world in a different way. Now these guys know some strategies that they follow. They got 4 key pillar strategies for looking at properties. So they'll buy the worst street, the worst house on the best street. Now that old cliche saying actually does hold true, and they do follow that as one of their leading principles. And they do use a margin of safety, so they won't over leverage. They'll make sure that they've planned their renovations properly, and this comes back to other books we've reviewed, where we're making sure we understand the numbers and we're using spreadsheets. And these guys, even though we talked about on Sir Bob Jones's book review how he likes to buy in areas he's not necessarily from, because that helps him just analyze deals based on the characteristics and not have a bias. These guys are a little bit different. They rather say buy where you know. And for when I talk to property investors, that's the general thing that I'll say, hey look, if you live in Manurewa, Manurewa, you can spot a deal in Manurewa, why not buy a property in Manurewa? If you want to self-manage it, you can. If you need to just pop down, you can. You'll understand more about that property than somebody that's not from the area. And these guys are real big proponents of investing with strong cash flow. So if you don't have strong cash flow to begin with, buying things like land or very low yield assets might not be the way for you to begin. Maybe part of your portfolio building process, the lifetime of it, is to focus on really high cash flow properties to begin with, within reason, and then build up your capital gains asset base from there. But cash flow is key, especially when interest rates can change and your income situation can change. You don't want to be over leveraging or putting yourself in that bad position. Now these guys are saying that you have to build habits that create wealth. And I've been listening to a lot of podcasts and reading things a lot recently about goal setting and about accountability. And one thing that I'm coming to believe is the best way to do it is to have a 1-pager of your personal goals, just one sheet, write out your personal goals just in short. And then what you want to do is every single day be looking at and potentially writing out those goals. And to build that habit of doing it every single day is to have a 66-day day planner, like a habit planner. So for 66 days, you do the habit of checking and writing out your goals every day, first thing in the morning, track your progress for 66 days, and by then it should be a habit. So you're using a habit tracker to track that you'll look down and write your goals. It's a bit of a hack. These guys are very big proponents of building your own business, finding a way to become self-employed in some form. Now, this is not swapping from being PAYE income to a contractor's income. That might actually damage your borrowing power. This is more going out on your own as a consultant, or maybe you're a bricklayer for somebody. Maybe it's starting your own bricklaying company. Maybe you're an apprentice plumber, and the goal is to become your own self-employed plumber with a team under you as soon as you possibly can. And this is the reason you want to own your own business: is you get time leverage, people leverage, financial leverage. You get more out of your time spent and more out of your money spent, and the leverage on systems is really, really important. You can't just build phenomenal wealth just from property investing. It's a very, very hard thing to do unless you've got extremely high income. And building a big portfolio will take a long time. If you can get a higher income from self-employment in some form or another, maybe that's buying into a business if you're not prepared to be your own your own business owner by yourself, then what you can actually do is get yourself in a position with a much higher income. And these guys are big proponents in that. And of course they love to talk about investing in coaching and mentors. Nobody is self-made. You might have seen the Arnold Schwarzenegger videos, the Rock videos. We talk about not being self-made. These guys definitely are not self-made. They've had heaps of mentors and coaches, and they're part of accountability and the mastermind groups. And you don't get to 700 units on your own. There's a lot of ideas out there that people are very happy to share, and I highly recommend this book. So there's one passage in here that I like to send to you. So there's a great case study in this book about creative property investing and seeing value where others, maybe they haven't seen it, or they're not prepared to invest the time and the money and the energy into uncovering it. So what Paul, he was buying a property, how do you get to 700 units? I can tell you got to do some creative deals that add a lot of equity, and that's one of Sir Bob's strengths. He was good at doing that as well. So Paul found a 100 apartment unit block, and it's 100,000 square feet of retail commercial in that block as well. And it didn't appear that there was any serious issues. The building, they were trying to sell it for $4 million. There was two serious issues, however. There was a dry cleaning plant downstairs, and the potential buyers were concerned about the environmental impacts. And then there was an 80-year-old boiler unit that people were worried might fail or cost a lot of money. The issues were the bank probably wouldn't finance on this property, so it was only going to attract cash buyers. So there's not many cash buyers around in the $4 million range. But these guys, they didn't know anything about the environmental risk. They didn't know about the boiler stuff. They knew that they had to do some due diligence on the property to see if they could, firstly, they would want to buy it, and secondly, whether they could fix those issues. So Paul's group, they paid $20,000 during their due diligence process to get a certified investigative report on the environmental impacts, and they uncovered how to fix that stuff. And then they also did a $25,000 report on how to fix the boiler. So they were trying to figure out, do we invest $45,000 in our due diligence process to decide whether we actually want to buy this property? So they spent a bit of money, and then the reports showed them that it was going to cost $125,000 to shut down this boiler and basically make everything safe and sweet. So what they did is they offered to buy this $4 million property at $2.4 million. And they spent about $60,000 on top of that for the due diligence. Long story short, they fixed up the property after securing it and buying this $4 million property. They tidied it all up, got a valuation after they bought it, and it was worth $4.5 million, and their total cost was $2.6 million. So, you can see the due diligence was a little bit of a risk, but they basically created $2 million worth of equity by spending about 200 grand. These guys were willing to take the risk and bet on themselves and work with professional consultants to uncover how to create the equity, and they were willing to do things that other people weren't willing to do, and they were handsomely rewarded. $2 million of equity. They're going to get all of their deposit back out. They're going to get bank finance, and it's a lot of passive income created from that one deal, and that will help create momentum and confidence to do more deals like that. So these guys really do know property investing. Highly recommend picking it up. Wealth Can't Wait. You can buy it from Book Depository, or you can probably get it on Kindle. More book reviews coming. Hit subscribe, and in the comments just let me know if there's any books you want me to look at, or you got any particular questions about this book.